few minutes remaining until today's closing bell. Joining us from the CME Group, Joe Cusick of OptionsXpress. He actively trades S&P futures. Also with us, Axel Merk of Merk Investments. His hard currency fund outperformed 96% of its peers last year. Axel is also a gold bull, and that's got to be paying off. Gold, as you know, rising to another record today. Axel, we were just talking about gold. I mean, how much higher do you think it can still go from here?
Well, the key difference between gold and currencies and other currencies is that the gold market is so much less liquid, so much smaller. And so when there's a flight into gold, it can zoom up quite a bit. The volatility is traditionally very high, hasn't been as high in recent months. But because of the policies around the world, people are concerned about inflation, not just the safe haven status that's around. And we see in England, for example, inflation numbers were again higher than expected. That's a leading indicator for inflation in the U.S. and around the world. And that's one of the reasons why gold is going to continue to do well in this environment. All
right, so how well? I mean, give me a price target for the next 3 months, next 6 months, perhaps.
Well, I'm not going to give you a target because it is so difficult. If there's ever a panic into gold, it can shoot up and double and triple. What we believe is that because the policymakers are preventing the market forces from playing out, that gold will continue to do well as so much money, both on the fiscal and monetary side, is thrown at the system. So we're long-term holders of gold and think gold is going to continue to do well for years, possibly and quite likely with a lot of volatility. But we think that gold will have to go up over the years to come.
Can you... would you say you prefer gold as an inflation hedge over equities? Because a lot of people say equities are a great inflation hedge as well.
Well, equities have the challenge in equities is that equity investment decisions are made these days based on policymaker decisions who throw around trillions of dollars. At the same time, if you're not in bed with the Federal Reserve, access to credit continues to be tight. So it's very difficult to make investment decisions, and everything moves in tandem. The reason why I like gold, the reason why we like currencies is because it allows for diversification to uncorrelated asset classes. And gold has been shown to be a good diversifier, an inflation hedge, and a crisis hedge. And so we think that it's going to be increasingly used in many portfolios.
All right. Joe, I want to bring you into this. We haven't forgotten about you. What happened today? We ran out of steam. We didn't have a lot of steam to begin with, but talk to me about kind of the mood there on the floor.
Yeah, well, right now the floor has a lot of anticipation about the industrial number coming out tomorrow, but they're watching. I know that right now I heard Axel talking about gold, but really the story has been silver. Silver's just been on a complete tear the last couple sessions, and it's really giving traders in the pit right now maybe a little insight that the industrials might be on the move, which would actually be good for stocks. We saw a nice move up. We've seen 8 sessions, 8 out of the 9 sessions, about an 8% increase in the last 8 sessions. And traders alike right now are sitting in these pits going, there is still quite a bit of momentum to the upside, and the options activity has been very brisk.
Hey, Joe, it's Dominic here. Speaking of silver and gold, that relationship, a lot of people saying that silver has this industrial demand for, right? About half of its actual demand is coming from people who use them for electric circuits and batteries and whatnot. Is that one of the reasons why you think it's a good industrial indicator out there?
I definitely do, and as of late, when you look at the relative price performance against gold, they've both been going up, and really it's been pretty well correlated over the last 10 years, almost a decade, with the markets, that when you see that silver is, from a price performance perspective, outperforming gold as it has been over the last 3 or 4 sessions, and looks like it could potentially continue to do so, the market tends to follow. But generally, when that relationship holds, you've seen that stocks usually follow as well.
Hey, Joe, it's Adam. Let me jump in here. I got to ask you, a trader down there in the pits, we're at the critical spot, that long-term moving average on the SPX. Can we get above this thing? What's the feeling down on the floor?
I think right now everybody is waiting to get over that 200-day moving average. I think right now really why people aren't just jumping all aboard when we see that we've been bumping our head above it a little bit here is the volume. Now, I know over the last couple months, and specifically this latest run-up of the last couple weeks, the volume continues to be light. This may be a September that's going to buck all Septembers historically. We're going to wait and see, but that resistance is stiff at that moving average in that 1120, 1130 range, and traders are waiting to see if some volume comes in here and starts pushing it up, especially as these fund managers that have been sitting on the sideline they've been underinvested over the summer. They're looking for an opportunity to get in this market, and they definitely don't want to be caught with their proverbial pants down while market's rallying to the upside.
Hey, and question, the follow-up here is, are guys short so that not only do you have a train that's left the station desire to get in, but also guys who have to cover shorts? Is that playing into it at all potentially?
You know what? That's a great question. I think we're seeing that tug of war coming into play right now. For the most part, we haven't seen a big short interest, and really we've been seeing more of the longs, the swing traders recently start unwinding positions. Today, as a matter of fact, towards the close, I've been seeing a lot of activity down there, so you could see them a little bit anxious to see what's going on. But actually, what we've seen today is that the shorts look like they're hitting that resistance point right at that 1120, 1125 mark in the cash on the SPX. So again, we're seeing that tug of war, and for those of you that are in the markets right now, get prepared this week for a tug of war with quad witching, with the expirations coming up towards the latter half of this week. We could see some real big, we could see some potential for some moves here.
I want to get back over to Axel and get to more of a macro discussion here. And Axel, you know, we talked to John Herman earlier. He was so excited about retail sales. He's turned a lot more bullish lately. You also think retail sales signal that we're in a reflationary trend. This is what the Fed wants us to be, and this is what everyone's pushing for in Washington. Why do you think the picture all of a sudden looks rosier?
Well, it's a pendulum we have. The market mood swings back and forth. Having said that, every time the market moves towards a panic mode, it swings less back in favor of the U.S. dollar. Today, for example, the dollar is down versus all major currencies. Gold is up, silver is up. And so in the reflationary trend, what happens is a lot of money is being thrown at the economy, and not much of that money sticks. That's why equities don't do so well. At some point, of course, some of that money will stick, but mostly it goes where you have the monetary sensitivity. That's the precious metals, the commodities, the currencies outside of the U.S. dollar. And so the policymakers are trying in vain to push this economy up. And the reason why it's in vain is because we haven't allowed the market forces to play out, the homeowners to downsize. And as long as that continues, gold will do very well because real interest rates are really negative, as if you ask anybody on the street.
Axel, I want to bring you back into this conversation here. In terms of the inflation idea, let me go back to it because, you know, it's traditionally an inflation hedge. We haven't seen any inflation here in the United States as of yet. Nonetheless, gold continues to outperform. Are you seeing any indications on the horizon that we have to start getting worried about inflation here in the United States?
Well, have a look at England. England is a small universe of what's happening in the U.S. The consumer has similar issues. The government has similar issues. Key difference is the market aren't as deep. There isn't as much confidence in the Bank of England. And so it's a microcosm of what may happen in the U.S. Their inflation numbers have started to be worse month after month after month. And in the U.S., we don't have that problem yet. But at the same time, with all that money that's being printed, the Federal Reserve is on a cliff walk. And I just don't buy the story that the Federal Reserve is going to be able to mop up that liquidity. And the reason why they can't mop up the liquidity is because there's too much leverage in the consumer. If they were to tighten in earnest, we'd plunge right back down. And so the best thing for the Federal Reserve is that we have this sluggish economy. But let economic growth kick in, and the Federal Reserve is going to be in real trouble. And that's what the gold market is signaling, that some of this may actually work and the economy may get going, but then the Federal Reserve is not going to be able to mop up the liquidity.
All right, Axel, thanks so much for joining us. Axel Merk there, and also thanks to Joe Cusick of OptionsXpress.